Hi, and thank you for joining this month's Market Minute. My name is Mike Mills, and I'm the co-founder and managing partner of the Legacy Advisor Group. Today is Wednesday, October 29th, before market open. This month, I'll give a quick update on the markets, share interesting thoughts on housing and demographics, and wrap up with some very interesting data from our friends at BNY on private markets. Let's start with a fun fact. The $65 trillion market cap of the U.S. stock market is $25 trillion higher than it was at the end of 2022. That growth in market cap in less than 3 years, just the increase, is higher than the total market cap of Japan, all of Europe, and the UK combined. That growth is higher than all of China's equity market value. It goes without saying the S&P 500 has continued its upward climb. International markets continue to outperform by the widest margin in 16 years as measured by the MSCI ACWI. One big factor behind international stocks' hot streak, a decrease in the US dollar. The Wall Street Journal Dollar Index has dropped 6.3% this year, primarily caused by concerns about President Trump's tariffs, Federal Reserve independence, and growing US government debt. This dollar weakness can benefit international companies as profits in foreign countries translate into more dollars. Interest rates across the spectrum from 1 year to 10 years are starting to flatten, with only the 20 and 30 year in the mid-fours, meaning we could be in for a slowdown. Inflation as measured by CPI came in at 3% last Friday, which gave rise to markets. So you see there are a number of indicators, some positive and some not so much. So will the markets continue to climb? For the near term, we believe yes. Is a pullback due? Also yes. But the question is whether or not we will get one before the end of the year. We saw disruption earlier in October when the China tariff talk increased, and then a bounce back as positive news has come out regarding tariff deals in China and Southeast Asia. I would not rule out a 5 to 10% pullback in the near future, and we stand ready for this. But I wouldn't be surprised if this also doesn't happen. So what's an investor to do? Stay invested and focused on the long term? You've heard me say this many times before. One thing we're doing is strategically and selectively trimming some gains and reallocating to defensive areas like dividend-paying stocks and other areas like alternatives. We continue to like private markets where appropriate. A few more points I'll bring up that we find interesting include that the U.S. fiscal year ended September 30th and fiscal year deficit came in at $1.775 trillion, which is $41 billion less than the prior fiscal year's $1.814 trillion. Now, before you start dancing, this is from tax revenues earlier this year rather than a decrease in spending. Another good piece of news is that housing cost increases are cooling off. Rent growth slowed noticeably in September and was up only 3.5% from a year ago, the smallest 12-month change since 2021. To put this in perspective, annual rent growth peaked at 8.3% in early 2023. The reason that this is important is because rent makes up about 35% of the overall CPI, and other data suggests rents will continue to decelerate. We have a chart from our friends here at JP Morgan that shows rents coming down in the components of CPI. A quarterly series called the New Tenant Rent Index points out that rent that is paid by new tenants only. Historically, this new tenant rent index leads the overall shelter part of CPI by about a year, which makes sense given that many apartments or home leases last at least 1 year. The key is that this index plummeted in the second quarter of 2025, dropping 8.4% in that 1 quarter alone, for a drop at a 29.6% annual rate. Not a typo there. By far the steepest drop for any quarter on record going back to the last 20 years. In other words, the rent portion of the CPI is likely to cool noticeably in the year ahead, which could help quell fears of high inflation and create room for some more modest rate cuts ahead. On the contrary to rents decreasing, you are still seeing rents remain strong primarily in Sunbelt states like Florida, Texas, Arizona, and others. Continuing with the theme of shelter, let's talk about housing and demographics. Millennials are in focus with their net worth at all-time highs, surpassing their parents at the same age. But the landscape is different as we look at housing. Boomers still control approximately 5 times more capital than millennials. Such a financial power imbalance will impact competitive dynamics for scarce resources such as housing. So this partially explains why the median age of first-time homebuyers is 38 and for all homebuyers is 56, both at record highs. Millennials and younger generations have choices to make about how they continue to adapt to an ever-changing economic and job environment. I recently read while traveling where there are 3 choices these generations can make. Now, these are the writer's words, not mine. The writer says you have reform, exit, and development. Reform, which is voting in candidates in favor of areas that help your personal and generational issues. The next is exit, which is an extreme change in what we see happening with the move in socialism and other extreme measures in certain areas of the country. And the last is development. This is my personal favorite. In the Marine Corps, we refer to this as adapt and overcome. That is, assess the situation, adapt by learning new skills, going against what the herd is doing, and focusing on improving your situation. As business owners, we subscribe to this. The author recommends something I also agree with, and that is to abandon all of social media advice and start reading. A few good books I like are The Richest Man in Babylon, The Millionaire Next Door, and the newer book, Psychology of Money. All of these are excellent books for the current and future generations to read and are much better than getting caught up in social media. Last, let's wrap up with a private markets overview from our friends at BNY Mellon. Private markets have exploded in size over the past couple of decades. Back in 2012, they were sitting at around $9.7 trillion in assets under management. Fast forward to 2024, and that number's jumped to $22 trillion. If private markets were a country, they'd be the second largest economy in the world, right behind the US. Performance-wise, private equity as an asset class has been a standout. Over 10, 15, and 20-year periods, it's consistently outperformed major public benchmarks like the S&P 500 and Russell 2000. Meanwhile, the public markets are shrinking. The number of publicly traded U.S. companies has dropped by about a half since 1996. And on the flip side, venture capital-backed private companies have grown 25-fold, and the cost of staying public is steep. Compliance alone eats up over 4% of market cap, and companies spend a staggering 425 million hours a year on regulatory paperwork. Innovation is increasingly happening behind closed doors. Only 13% of U.S. companies with 100 million or more in revenue are public. And when it comes to billion-dollar valuations, there are 6 times more private unicorns than public companies. This chart from BNY on percentage of private markets by revenue is interesting. What you see is a chart of percentage of U.S. companies by revenue. In the public market, approximately 3.9% of public companies generate 100 to 499 million in revenue, and approximately 6.7% of public companies generate greater than 1 billion in revenue. Whereas approximately 65% of private companies generate between 100 and 499 million dollars in revenue, and 10.7% of private companies generate revenue in excess of 1 billion. Some of the biggest names in tech and AI like OpenAI, SpaceX, Anthropic, Stripe, Databricks, Anduril, and xAI have seen their combined valuations skyrocket from $264 billion in 2023 to $1.4 trillion today. AI and frontier technologies are dominating the venture capital landscape. Since 2023, half of all venture capital funding has gone into AI. Big players like NVIDIA, Google, Microsoft, and Amazon have invested nearly half of the top 100 AI unicorns. We're also seeing momentum in new asset classes like fusion energy, quantum computing, and space infrastructure, with companies like Helion Energy, PsiQuantum, and Sierra Space leading the charge. And finally, the lifespan of public companies is shrinking fast. In 1958, the average S&P 500 company lasted 61 years. Today, it's just 16. A clear sign that innovation is starting in private markets and staying there longer. Well, that does it for this month's Market Minute. As always, if these thoughts spark questions or concerns, please reach out to us here at the Legacy Advisor Group. We always enjoy talking about the economy and markets. However, planning is what really matters. If you have a friend, coworker, or family member that could benefit from planning or just have questions, please be sure to pass along our information. And on behalf of our team, thank you for your trust and your friendship. If we don't speak before the holidays, we hope you and your family have a wonderful Thanksgiving and Christmas. And have a great day.